In this video, you're going to learn how to use OPM or other people's money to help you fund your commercial real estate investments. Now, let's face it, at some point in your investment career, you're going to run out of money. What do? You shouldn't stop. You must not stop. You're going to have to learn how to raise private capital from individuals. Now, what I mean by that is to learn the techniques and tactics and laws of going out in the public and raising capital and pulling your investors' capital and their resources along with yours to complete a deal. Okay? In other words, raising a down payment. This process is called real estate syndication. I am Peter Harris with Commercial Property Advisors. I'm author of this book, Commercial Real Estate Investing for Dummies. Also, author of this book, Commercial Real Estate for Beginners. You can get your free copy of my new best-selling book by clicking on the upper right-hand of the screen. I'm also a coach and mentor to many commercial real estate investors all across America. All right, and so in today's video, we're going to learn all about how to syndicate your commercial real estate deals. Number one, I'm going to tell you what is syndication, reasons why we do it, and the 3 ways to profit greatly from syndicating your deal. Number 2, what are the 4 most important things to know when syndicating your deal? You don't want to miss that. Number 3 is, how do you find these investors? Number 4, how many investors do I need per deal or just to get started? And number 5, I'm going to share with you how to convince your investors to invest with you. And at the end of that segment, I'm going to give you a link to a tool that you can send to your investors to see if they're interested. And number 6, I'm going to give you the top 3 questions investors will ask you. Now, these questions, you are guaranteed to be asked these questions, so you better know the answers. And lastly, I'm going to give you a real deal example that I'm going to break down for you in fine detail. Okay, so let's get started. Let's get started with what is a real estate syndication and why do we do it. So I have a quick illustration here that I will share with you. All right, John here has found a 3-property portfolio of commercial properties that he likes. They cash flow well, they produce great returns in a great area. John does not have a whole lot of money. He has experience but no money. He can probably buy 1 but not all 3. So what John does, he decides to syndicate the deal. So he goes out and he finds his good friend Jane, who he has known for years, right? Now, Jane has lots of money, lots of net worth, but she has no experience. So she has no confidence that she can buy this and operate it successfully. So she would love to work with John, right? Now, knowing that this is this requires a larger down payment, they decided to recruit Jim, who just come along for the ride. Jim would just be a financial partner for them. Okay? Now, what they do next is they go out to hire a syndication attorney to help them put together the syndication paperwork. All right? So what they're going to do is the attorney is going to have the 3, John, Jane, and Jim, start JJJ Invest LLC. So this will be the syndication. All right? And now this LLC is going to be funded by John, Jane, and Jim, and then the LLC will purchase these 3 properties. All right? So this, in essence, is a syndication. All right? Now, the question is, why do we syndicate? Why? Well, here's the answer, right? Let's say that you have an outstanding deal that John had, but there's no down payment money, he's very short, right? So in that case, you would syndicate the deal by getting a person like Jane and Jim to help you. Another reason why we would syndicate is, let's say you have the down payment like Jane, but you have no experience. So you want to bring in the experience, you would syndicate the deal with John and Jim, right? Or let's say that you just want to close on more deals by leveraging everyone's financial resources and experience, right? That's what syndication is. Now, the other reason could be, and this is a very popular reason for people my age, is syndication can help you with retirement planning, right? I call syndication your personal pension. That's what I call it, right? So this is what syndication is. The fifth reason of why you may want to syndicate is to make fees, okay? Now, here are some of the fees you can make. Since John will organize the syndication, hire the attorney, do the due diligence, and do a lot of the legwork, John can charge a syndication or acquisition fee, let's say, between $10,000 and $25,000 just to put it together, all right? Now, after they close, John is also going to look after the property management and help prepare the tax returns for Jane and Jim. So on a monthly basis, John would do the oversight, not the property management, but the asset management oversight. He can collect what we call an asset management fee for that every month. That will be about maybe 1% of the rent collections that he could collect on a monthly basis. So there's some pretty good fees in it for John. Now, another set of fees, let's say that Jim was a real estate agent, all right? Now, in about 5 years, they're probably going to sell the properties, right? Now, since Jim was a real estate agent, Jim can be the agent and collect the commissions on this portfolio sale, all right? So that's what syndication is, and that's why we do it. The next thing I want to jump into is what are the 4 most important things that you need to know when raising capital. Let's go there. Let's jump into the 4 most important things to know when raising capital. Number 1 is it's a relationship-based business, okay? This journey you're about to embark upon is a relationship-based business. It's about people. So what I want you to do is to be yourself, but be genuine to people, care about the people, and honor the relationship. Call people back when you say you will. Do what you say and say what you do. All right? It's very important. If you do not get this part about it being a relationship-based business, you will not be in this business very long. Okay? I will always say that commercial real estate is a relationship-based business. Understood? Okay. Number 2, I want you to put the investor first. All right? This is a mindset. Put the investor first and put yourself second. Here's something to grasp. Let's say you have to raise a certain amount of money and the only person that will invest with you is your grandmother and it's her life savings. How well would you be a good steward over that money? A pretty good steward, right? Because it's your grandmother's life savings. That's the mindset I want you to have when you go out to recruit an investor and use their money for your investments. All right? So again, put the investor first and yourself second. It's not about you, it's about them. That's the mindset you need to have. Got it? Okay. Number 3 speaks for itself. The efforts in doing syndication, right? They need to be systematized and structured for efficiency and for legal reasons. All right? That's I'll leave it there because syndication is not a simple thing to do. There's lots of moving pieces. There's lots of things to learn, right? But whatever is great and worth achieving, it's worth going through the efforts. All right? But it needs to be systematized and made efficient for you to work properly. Now, number 4 is probably the most important thing. Don't try to do this by yourself. I need you to hire an attorney who's experienced in syndication. You can set up a syndication and do one wrong thing with the paperwork, and you can have a lawsuit or even worse, right? So I want you to hire an attorney because what an attorney would do is they will give you the proper documents, all the required documents. They will give you all the disclosures you need, and then they'll set you up for the protection that you and investors will need. Now, all the documents, disclosures, and protections are kind of set up through what we call the SEC, the Security and Exchange Commission. They are the governing body. You see, syndication is all about the complying to the strict laws and regulations that protect the investor. And if you don't follow these rules, again, there could be a lawsuit or even worse. All right? This video will not cover those SEC laws, rules, and regulations. I don't have time for that. That will be another 2 hours, all right, to cover it all. So I'm just making that disclosure now. We'll not cover that. All right, so number one is a relationship-based business. Number two, you need to put the investor first. You're second. It's not about you. Number three, be systematized and structured when syndicating. And number four, hire an attorney to do the paperwork for you. It's not worth it. Don't try to do this by yourself. It's not worth it. All right? Okay, so the next thing I want to talk about today is the 3 ways that a syndicator can profit greatly. I'll see you there. Let's jump into the 3 ways that syndicators can profit from syndication. All right, number one is when you syndicate a deal, the first type of way to profit or to achieve a fee or pay is to get an acquisition fee. So let's say that this is your deal and you're going to syndicate it, you're going to pull people around and arrange the deal, so it's your deal. If you were to find a deal, do the due diligence, structure the deal, do the legal legwork to make sure everything's right, hire the property management, and arrange financing, you are entitled to what we call an acquisition fee, right? And any amount between 1% to 5% of the project size. So let's say it's a $5 million project. A 5% fee would be what, $250,000, right? So you can achieve that fee, or it could be just a flat fee. All right, you got to be careful with the fees. You got to make sure they're not over the top. You make sure your investors think it's a reasonable fee. All right, so that's the first way to profit. The second way to profit is through an asset management fee. Let's say you have closed the deal. Again, you're in charge, and then you're going to manage the partnership. All right, so you have several partners in your syndication. You're going to be the main person, okay, the head honcho. You're going to manage the partnership. You're going to oversee the property management on site, make sure they're doing everything correctly. You're also going to oversee if there's any construction going on to renovate the parts of the building. You're going to oversee those type of things. At the end of the year, there's year-end tax prep. You're not doing the taxes. Your CPA is doing the taxes, but you're going to make sure everything is going at an orderly pace to make sure things are filed on time. And then you're going to be the person compiling the reports and report to the partnership how the property is performing and if you're meeting your objectives. And lastly, exit strategy. You're going to keep a laser focus on the exit strategy, because let's say in 5 years you have to sell at a certain level, right, to receive a certain return on investment. This is the asset manager's responsibility to make sure things are on track. All right, and if you are the asset manager, you get an asset management fee in the range of 1% to 5% of the monthly gross income. Okay, so over month and month and month, it can start to add up, especially when you add an acquisition fee. Okay, and or you can just charge the syndicate a flat fee. It's up to you. So that's the second way. The third way to achieve profits through syndication is probably my favorite way. This, I put a dollar sign here because this is where the big dollars are made. So equity participation. Equity participation is when you have an ownership stake in the property, okay, in the syndication. And whatever you do, whatever you put, if you put money in or you sign on a loan or whatever your role is, and you have an equity stake, it can range between 5% ownership and 50% ownership. It just depends on what you do. Now, here's how it works. Let's say you pay your investors an 8% preferred return. Okay, so the first 8% that the property produces gets paid to the investors first, and whatever's left over, the equity partners get second. Okay, so if there's cash flow of 8%, goes to investors first. Whatever's after 8% gets split between the equity partners. Or let's say that you sell the property. All right, again, the investors get paid first, so from their sales proceeds, and the equity partners whatever your split is, 5 to 50%, you get that as a second payment. Okay? So those are the three ways to get paid and to profit from syndication, this being the most profitable way. All right? And I also have a fourth one I share with you. I mentioned this a few minutes ago. A lot of syndicators are also licensed real estate agents, and they will sell, with permission of the partners, they will sell the asset to make a commission. So if that's your thing, you can do quite well with that endeavor as well. All right? Okay, so the next thing I want to share with you is something very interesting, how to find these investors. Okay, so let's go there next. All right, let's jump into a very fun topic called how to find investors. Okay, one of my favorites. Now, I teach a lot of investors how to raise capital, and we all have to have our humble beginnings of where to start. I started here. My students start here. Some of our students have gone on to raise millions of dollars by starting here. So it is with you. No one's going to give you investors. No one's going to hand over money to you or hand over people with money to you. You have to go out there and get it. All right? Okay, so here's where you're going to start. You're going to network at RIA meetings, real estate group meetings, meetup.com meetings that are real estate related. You're going to try your inner circle, all right? Friends, family, co-workers, former co-workers, all right? So this is the start. This is your humble beginnings. Now I'm starting to think out there, some of you are thinking certain things, and you're coming up right now with one of the lamest excuses I get when it's time to raise capital. Here's the excuse. Peter, I don't know anyone with money. They're all broke. All my family, my friends, they're broke. They have no money. My co-workers, I'm too embarrassed to ask them for money. All right? So I know that's what you guys are thinking. That's a lame excuse. Lame excuse, because we all started here. My students all had the same excuse, but they went out there and did it. All right? So this lame excuse you just gave me, forget it. Okay? It does not exist. Okay? You can have the excuse, but we're not going to live it. Got it? Okay. Because I want to give you the truth. Here's the truth. There's 4 truths. Number 1 is you just don't know anyone yet with money. They're out there, right? In fact, there's more money out there than there are deals at this moment. Got it? So there's more money out there where you are than there are deals. The deals are hard to come by. There's a lot of money out there. Thirdly, money follows good deals, right? That is certain. Now, your job is to put together good deals. That's your job. Put together good deals, because good deals, money follows. Okay? Money follows good deals, because there's more money out there than there are deals, because if you do all this, you're going to find a person with money. All right? Okay? So that's the truth right there. This excuse is not the truth. All right, next I want to challenge you. And what I want you to do, if you can take out a pencil and a piece of paper, I want you to write down 24 people. Okay? This challenge is going to help you raise capital. This is what our students do, right? This is what they do. I want you to write down on a piece of paper 24 people, right? People that you know with money, and people that you know who may know people with money, but it has to be 24 people. Once you have your list of 24 people, I want you to send out what I call our executive summary. It's a tool that our students use in our program to send out to potential investors, see if there's any interest. It's called an executive summary. In a few minutes, there's going to be a link up here they can click on and download it. It's a Word document. All right? So I want you to send that executive summary to 24 on the list. Now here's what's going to happen. Out of those 24, 12 are going to be interested, right? 6 are actually going to read it, right? 3 will want to talk to you, and 1 will invest. That's the ratio. 24 to 1, because you're a beginner. Now, after you have a track record, your ratio could be 2 to 1 or 3 to 1. But when you're first starting out, you can't take a shortcut here. It is 24 to 1. All right? So no one said it's going to be easy. But anything worth great going after, it's not easy. It's not. All right? So 24 to 1. All right? So there. I just challenge you. I bet you if you do that, you're going to get results. All right? Now, the next thing I want to do is talk about how many investors do you need to get started or to do your first deal. And I'm going to add to that, the question is, what do I do first? Do I get the investors first or the deal first? I want to answer those when we come back. All right, let's jump into two really fun questions. Question number one is, how many investors do I need for my first deal? And secondly, what comes first, the investor or the deal? Let's jump right into it. Number one is, how many investors do I need? Here's the short answer. The short answer is double. Let me give a long answer. Let's say that you need to raise $250,000 as a down payment for your deal, right? So what you need to do there, what I mean by double is, even though this is how much you need to raise, you need commitments of $500,000, all right? So you need people actually making commitments that, Peter, I will send you my check, and then out of all the investors, it's going to equal $500,000, even though you need $250,000, right? The reason why is because the people you're dealing with are called humans, and humans have human issues that come up in life. For example, them not having the money, the timing may not be right, their spouses may object. So this $500,000 will quickly dwindle down to the money that you need. Got it? Okay, so the answer is double. So if you need to raise $250,000, have commitments for $500,000. Got it? Okay. Second question is, what comes first, the investor or the deal? Well, I'm going to give you two perspectives, and I'll give you kind of a more personal perspective. Number one is, if you're a beginner, right? If you're a beginner, you want to have the investors lined up first. That just makes more sense. And that will make you more at ease that when you do find a deal, you have investors to go to raise the money for, rather than vice versa. Okay? Now, if you're seasoned, if you're a veteran, if you have a track record, you can go for the deal first because you already have investors lined up. All right? So it makes sense? Now, here's a different perspective. We teach our students to do, even if they're beginners, to go for both at the same time. So work on a deal and find investors at the same time. Now, here's what happens. A typical student will find a great deal that can be a life changer, right? And they have zero investors lined up. Because the deal is so grand and so great, they will do whatever they can to find that investor. And most times, they're successful. All right? So even though this is common sense, a lot of times we just have to jump in and just go for it. All right? Okay, so the next thing I want to talk about is something I think you'd be really interested in, and that is how to convince investors to invest with you. All right, so let's go there next. All right, next is how to convince investors to invest with you. All right, let's get started there. Well, let me start here. Is when you have made an appointment to speak to an investor, or you're just sharing your deal with someone to see if they're interested in becoming an investor, what they're thinking about as you're sitting across from them is they're thinking three things. They're thinking about you, right? Can I trust you? They're thinking about the deal, if it's good enough, and they're thinking about the risk. All right, so we have you, the deal, and the risk. So in this first meeting, we have to address those three things rather quickly. All right, so in these 7 items here, I address you, the deal, and the risk right here. Let's get started. All right, so number one, these are the 7 attributes that you need to address to get investors to work with you. Number one is you want your deal to be priced under the market, right? Everybody likes a deal. You don't want to send to your investors a deal where you're overpaying, right? Okay? So number one, the deal must be underpriced. Number two, you want your deal to have some income upside potential, right? So can we raise the rents over time? Can we get higher lease rates over time? Because higher rents and higher lease rates means higher income, higher net operating income. And remember, as the net operating income goes up, so does the property value. So having income upside means you have property value upside too. Investors love that. All right. Number 3 is excellent cash on cash return. This is your ROI, right? I put an asterisk here because this is what investors that are coming to your investment, this is what they're focused on. They're focused on the ROI. You know why? It's because they're as you're speaking about the investment, they're thinking that their IRA, their 401k just produced 2 or 3%, maybe even 1%, right? And you're talking, Mr. Investor, I'm projected to make 8% per year over the next 5 years, or whatever it is. It'd be probably in that range, right? But they're thinking their 401k, their self-directed IRA just produced 1%, 2%, 3%. So you're blowing it out the water. So number 3 is have an excellent cash and cash return. Number 4, you need good demographics. Demographics are number 1, the jobs, number 2, the neighborhood. All right, all those things must equate to good. All right, good demographics. All right, remember, probably the most important demographics for commercial real estate is jobs. Right, no jobs mean no rentals. Right, no new leases. So we need jobs. So make sure wherever you're investing, wherever your deal is, the job scene is solid. Number 5 is you need to have a realistic exit strategy. All right, realistic. If you tell your investor you're going to reach here, you may want to tell them you're reaching here, but between you and your team, you're going to go here. So you're kind of dampening expectations. You're promising here, but you're shooting for here, so you can exceed their expectations. So have a realistic exit strategy. Okay, nothing too over the top because they won't believe you. Be too risky for them. All right. Number 6, you need to have a track record. Right. Either your track record. If you don't have one, you can get someone else on your team that has a track record. All right, so don't let this stop you. Have someone on your team with a track record. Give them some equity participation to come on the team to get the deal done, okay, and to lend their experience. All right. Number 7 is you need to prepare an executive summary. Right, that is a 1 or 2 page document that just goes over the highlights of the deal. It's a very short form. I personally believe that if you cannot explain your deal in 1 page, you don't understand your deal, right? So 1 page to lay out your deal. Also, you think about, people are very busy. They don't have time to read 5 or 10 or 15 pages. They can read 1 page during their lunch, all right? So executive summary, prepare one of those. So what we're going to do for you is we're going to provide a link for a download to our personal executive summary. A link is going to appear right here for you to download. It's a Word document that we use to send to our investors to gauge interest. It's just to gauge interest, that's all. Okay? All right, so that's going to be up here in the link right here, so go ahead and download it. All right, so these are the 7 deal components you need to get yourself in the best position to get investors to invest with you. All right, my last word of advice, okay, probably the most important, is start small. Okay, there's no reason for you wanting to raise this amount, right, when you're first starting out, right? Start here, then build up to the higher levels. All right, okay, so the next thing I want to go into is I want to share with you what the top 3 questions investors will ask you. So you better be prepared, because I guarantee you they're going to ask you these 3 questions. All right, let's go there next. All right, let's jump right into the top 3 questions investors will ask you. Now, these 3 questions are probably the most popular questions when you sit in front of investors. So prepare yourself, okay? Look at these questions, look at the answers, and get ready. Question number 1 is there a guarantee that I'll get my money back? All right, here's your answer. No, right? There is no guarantee. There is a universal risk with any type of investments, in stocks, real estates, whatever. There's a universal risk, so you cannot guarantee that they'll get their money back. However, you can tell them that the property will be owned in the LLC, so it'll be sheltered there, it'll be protected there for protection and privacy sakes, right? In addition to that, you'll have insurance, hazard insurance, liability insurance on the property, just in case there's a fire or flood or there's some other type of claim against the property, the insurance will cover it, okay? So that's the only thing you can tell them, all right? So that's question number one. Question number two is, when will you return my money? Your answer is, well, it depends on the exit strategy. So, excuse me, your exit strategy must be thought out ahead of time before the meeting, right? So if your exit strategy is to buy the property, hold it for 5 years, fix it up, increase the NOI, increase the value, pay down the mortgage, stabilize it, and then sell it for a profit, all right? And that takes 5 years. Your answer is, when will you return my money? In 5 years, right? Typically, most syndicated deals last between 3 and 5 years. That's typical. Investors mainly don't want to see their money out for longer than 5 years, all right? So 3 to 5 years is typical. Number 3, do I get tax benefits? The first answer out of your mouth is, I'm not sure, it depends on your status. Talk to your CPA. That's the first answer out of your mouth. Then you can add a few things, such as if the IRS deems you to be a passive investor, which most are, by the way, and then you get no property tax write-offs. So at the end of the tax year, whatever cash flow you receive will be what you will be taxed on. However, if you are classified differently per the IRS, again, I don't want to get too much into this, it's very possible that your cash flow may be sheltered by the property's expenses. It just depends on your tax status, all right? So that's a tax question. Ask your CPA for more clarity on that. All right, okay, so these are the top 3 questions. Memorize them because you will be asked. All right, so the last thing I want to do here, it'll be a short presentation, is to go over with you a real deal example. All right, let's go there real quick. All right, we're down to the last piece here. Thanks for hanging there with me. Hope you enjoyed the previous few minutes. Now I want to share with you a real deal from one of our students. It's a 24-unit apartment building. He paid $925,000 for it. The down payment was $200,000. And he were able to raise the $200,000 from 2 investors. Okay? I'll go over what the investors are getting in a second. We found out that the rents can be raised $150 per unit. That's significant, right? The owner was living out of state and had no idea what the rents could be because he had very little debt on the property, so he was fine with his cash flow. So he has no motivation to increase the rents. So this was just a bonus for us, right? So $150 per unit, over 24 units, that's $3,600 more per month. That's significant, right? Multiply that by 12 years and you get an annual number. So $43,000 more income per year by raising the rents $150 over the course of 2 years, okay? Now, the $43,000 increase in income. As you guys know, you watched many of my videos, as your net operating income goes up, so does your property value, right? I'm not going to go over that equation with you. It's in my previous videos, so please watch those, right? But if I divide my new income, my additional income by the market cap rate of 8%, it will give me my increase in property value. Okay, so I did the math here. 43,200 divided by 8% gave me a $540,000 increase in property value. So he bought it for $925. We're going to add the $540 to it, right? So the property is now worth $1.465. All right, over 2 and some odd years. Okay. Now the question is, how did he structure this deal with his 2 investors? Here's what he did. The investors are going to earn an 8% preferred return, plus they're going to get an equity split when the property sells, right? And this whole deal is lasting for 5 years. All right. So let me break this down for you. So investors are going to get an 8% return on their $200,000 per year, right? Preferred return. Preferred means that the very first money that comes out of the property cash flow goes to the investors. So it's preferred return. Investors are first, he is second. Okay? All right, so preferred return, plus is getting a 25% equity split. So when he sells the property, investors will get an extra 25% bonus on the sales proceeds when the property sells. Okay? So again, 8% preferred plus a 25% equity split. It's pretty generous. Now, here's the extra strategy. This is probably the most important part that made this deal easy to raise cash for, right? Extra strategy was to increase the rents over time. So he did this over 2 years. He's going to do a cash out refi. So he's going to bring up the property value, bring up the NOI, bring up the property value, stabilize the property here, go to the bank and do a cash out refi. He's going to refi the first loan, put a second loan on the property, and pull cash out. He was able to pull out the entire $200,000, okay? And he's going to pay back all of the investor money, give all their money back, right? Now, the other thing he's going to do, which I think was brilliant, right? He's going to allow the investors to maintain a small piece of ownership, right? So here's the benefit of that. The investors have all their money back, right? But they're still getting quarterly checks from their property, even though they have no money in, right? So the reason why we did this is because how likely do you think that they will reinvest with him? Very likely, right? If they have all their money back and now they're still getting paid from the property, all right? So that's how the deal was structured, right? So, but the most important thing we're going to have our student here do is to repeat. Do this over and over and over again, right? So that you can build up wealth, right? Get practice, build a track record, do larger deals. All right? Okay, so this is my real deal example. It's a great deal, something I'm sure that you can do now that you watch the rest of this video. All right, so if you want more resources and training like this, please go onto our website, commercialpropertyadvisors.com, or simply subscribe to our YouTube channel. Thanks for watching the basics of real estate syndication. I'll see you at the next video.